So Warren Buffett just sold all of Berkshire Hathaway's S&P 500 index funds. And that has a lot of retirees wondering, should I do the same? Does Buffett know something we don't? But before you make any sudden moves with your retirement portfolio, we need to break down what Buffett actually did, why he did it, and what it means for your retirement investments. So in this video, I'm going to talk about the real reason Buffett sold, how market downturns actually work for retirees, and then 6 actionable ways to protect your retirement without making the ultimate mistake. And most importantly, we're going to determine whether you should follow Buffett's moves or if this is just another case of the financial media hype. So I want to start by clarifying what actually happened. Yes, Buffett sold 100% of Berkshire's holdings in the S&P 500 index funds like SPY and VU, but here's what most people miss. These holdings were just a tiny fraction of Berkshire's $350 billion plus portfolio, just 0.1%. Berkshire still owns many individual stocks that make up the S&P 500, like Apple, Coca-Cola, American Express, and lastly, Buffett's strategy isn't yours. He's sitting on a record $150 billion in cash because he's looking to buy entire companies, not just index funds. And this wasn't some grand signal that the stock market is doomed. It's just Warren Buffett playing his own game. But I totally understand why retirees would get nervous. The market is at all-time highs, valuations are stretched, and even Buffett is sitting on a massive cash pile. So let's answer the bigger question. If Buffett is reducing exposure to the market, should you do the same? Well, I'd say the answer lies in 2 critical truths about market downturns and how to actually prepare for them. The first one is that market drops are frequent, but not always catastrophic. Now, historically, the stock market will have a 5% drop on average every year. That means those red numbers in your statement are normal and expected. But bear markets, where stocks fall about 20% or more, only happen once every 6 years. The big problem is that no one can consistently predict when they'll happen, no one can predict how long they'll last, and no one can predict the perfect time to get in or out. Now, Buffett himself says that the best strategy for most investors is not market timing, it's holding a low-cost index fund for the long term. So even though Warren is selling, he never said we should follow his trades. Okay, so number 2, all-time highs do not mean an immediate crash. It's easy to look at the market today and say, hey, you know what, we must be due for a correction. It's grown, but this might surprise you, history shows otherwise. So here's some really interesting stats here. Since 1950, 7% of all trading days have been new all-time highs. That's 1 of every 14 days. If you sold every time the stock market hit an all-time record, you would be making a massive mistake, and historically, you'd miss out on all the biggest gains. As one of my favorite bloggers, Ben Carlson, puts it, he says, quote, if you're nervous about investing at all-time highs, maybe you shouldn't put all of your dry powder to work in the stock market. The amount you invest should be the amount you're willing to hold through both bull and bear markets. So what should we do instead of making the ultimate mistake of trying to predict the next crash? Let's go through some things that we do with our successful retirement clients that protect their retirement and allow them not to make fear-based decisions. And number 1 is to hold purposeful cash reserves. Now, Buffett may be sitting in cash, but that's because he's looking to buy whole businesses. And most retired folks are not trying to buy a new company. Here's how to think about how to find the optimal amount of cash reserves for you. And it's by understanding this. For retirees, cash isn't an investment, it's a safety net. Number 1, you need to keep an accessible liquid emergency fund ready, whether that's just holding straight up cash at home or in a checking account. Number 2, consider 1 to 3 years of spending in high interest savings or conservative investments like treasury bills. And then lastly, keep additional cash reserves inside your IRA or your brokerage account that is ready to create income. But keep in mind, the end goal is to have enough cash to avoid selling stocks during a downturn, but not so much cash that inflation kills your purchasing power. Number 2, use bonds as a second layer of defense. If Buffett is worried about overvalued stocks, bonds can provide that balance. A potential way of accomplishing this is focusing on high-quality bonds like U.S. Treasuries or investment-grade corporate bonds. Secondly, for market downturns is to keep durations shorter to intermediate term to reduce volatility in your portfolio. And then what this does is create a barbell strategy where you have stocks for growth, bonds for stability, and then you have cash for the immediate term. The goal is that when markets drop 20 or 30%, your bonds and cash keep your retirement paycheck uninterrupted. So that way you can give your stocks enough time to recover. Number 3 is to plan for big expenses before they happen. If you have a major purchase coming up, like a new car, a home, renovations, or helping the family, if you keep that money in stocks, is where you can run into a lot of trouble. For those big expenses is often why keeping money in those shorter term stable assets for expenses makes a lot of sense. And what this does is it avoids having to sell investments at a loss when markets are down. Number 4 is rebalance proactively, not reactively. The average person will make the ultimate mistake of panic selling at a downturn. But a better approach is rebalancing, right? If stocks run up, you may be a 70-30, whatever. If it goes above 70-30 to 80, now you take advantage of that growth by rebalancing back to your target. If stocks fall, rebalancing using some of your cash by buying at lower prices, you can take advantage of the downturn. For example, during COVID, when stocks dropped by 30%, if you had that cash and bonds in your portfolio, you actually were able to rebalance and buy more stock at a lower price, so when the market recovers, you were able to take advantage of the upside. For our firm, we find that doing a 20% drift is optimal, meaning you don't have to rebalance constantly just when your allocations move significantly. And I'm going to include that research in the show notes below so you can check it out for yourself. Okay, so the 5th consideration is to carefully consider alternative assets. A lot of investors are asking, should I buy gold, or maybe should I buy Bitcoin, right? Gold has been a historical hedge, but its long-term returns lack stocks. Bitcoin is still speculative, but again, it has some potential, but also a lot of volatility. Alternatives are not an asset class. They can mean 1,000 different things. You want to make sure it does complement your portfolio as well. Ideally, things like gold, Bitcoin, or other alternatives can be fine as part of a small part of a diversified portfolio. It's just not very common that people rely on them for that safety. And then lastly comes your withdrawal strategy. Now, we use a risk-based guardrails approach, but you can do some research on things like the Guyton's guardrails for your spending if you're more DIY. But what this helps do is avoid that sequence of returns risk, which is basically spending too much too early on, putting your portfolio on a path towards running out of money. If we look at this quick case study of John and Mary, who withdraw $10,600 per month from a $2 million portfolio, let's walk through how this works, right? If their portfolio rises to $2.1 million, they give themselves a small raise, right? They can spend a little bit more. But if it falls to $1.5 million, they reduce spending slightly to preserve that longevity. A strategy like this can really be perfect for those worst case scenarios like 2008 or early 2000s type retirement situations and help you reduce the chances of running out of money in retirement versus just saying, I'm going to take 4% for the rest of my life. So after all this, should retirees follow Warren Buffett's move? The short answer is no, because his strategy isn't designed for retirees. Instead, retirees should prepare for downturns by focusing on cash and bonds as a buffer, right? Rebalancing instead of panic selling, and having a disciplined long-term withdrawal plan. And if you want to learn more about those risk-based guardrails approach, at least what we do with our firm, I break it down further in this video that you can watch by clicking right here. If you'd like to talk to me or someone on my team about your plan to retire, you can book a call with our team using the link in the description below. We look forward to talking with you, and I'll catch you guys on the next video.